Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Cronemeyer. I'm Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. And today, on today's call, we're going to be focusing on what happened in the markets last week, and then most of the time, Graham's going to talk about the market volatility, with what's going on with some bear markets and some recessions and things like that for the rest of the call. So, Graham, I'll let you take it away.
Hey, thank you, Jeremy, and thanks for everyone jumping on the call. So let's get into the numbers. I mean, volatility. I think that's the name of the game. We saw U.S. stocks really see a huge historical midweek rally. We saw the S&P 500 gain about 9.5% on Wednesday, and then finish the week up about 5.7% higher. The Nasdaq jumped about 12% by Wednesday and ended the week up about 7.3%, and the Russell 2000 small cap was up nearly about 2%. So as I mentioned, start of the call, volatility was the name of the game. It was all about tariffs and the ramifications or the expectations, so on and so forth, that were implemented from this administration. So if we look at the Treasury yields and the dollar index, we saw the U.S. Treasury yields experienced their biggest weekly spike since 2001, while the dollar on the flip side went down about 3%. Same thing with gold and oil, a little opposite directions. We saw gold reach an all-time high of about $3,250 per ounce, rising about 6.3%, where we saw crude oil dropping about 1%. If we look at economic indicators, we did see the U.S. CPI ease in March with about a 12-month inflation rate falling to about 2.4%. So we are seeing a bit of a moderation, probably with some concerns of what these tariffs would do to the growth or maybe lack of growth that we might be seeing going forward in the near future here with the U.S. economy. But we saw the producer price index fall about 0.4% month over month, with the inflation expectations for next year surging, I mean, as high as 6.7%. Now, they're not there. That would be the highest since 1981. But that's all going to be in line to how much the tariffs are going in, what is the pricing that's going to be coming over that we're going to have to pay for as consumers and businesses. If we look at consumer borrowing and small business optimism, I mean, that declined in February. Small business optimism dropped to the third consecutive month in March. We did see some FOMC meeting minutes come out, Federal Reserve minutes coming out, highlighting their concerns about inflation, the slowing economy, not making direct comments about the tariffs, but I think they're reserving the right to or the option to make a comment until we get a good bit more clarity. We are going to be moving into some earnings here as we come into this week. So again, this week's going to be a lot about the tariff talk, the ramifications. Are we going to see slowing and what degree in the economy? Even though, keep in mind, we were coming into this year expecting a little bit slower growth, maybe a little more moderation in earnings for company, but maybe not as much as we're expecting right now if the tariffs hold true, at their current levels. Volatility is going to be the name of the game. We'll get some economic reports out. March retail sales, the Empire State, Philly Fed manufacturing, and then we'll have some Fed speak. We got Fed Chairman Powell coming out with some committee members taking their rounds, commenting. So we'll get some feedback on that. And as I mentioned earlier, earnings. We're going to see the financials rolling out this week. They usually lead Goldman Sachs, Citigroup, Bank of America, American Express, setting the tone with some tech stocks like Taiwan Semiconductor, ASML Holdings, Netflix, as well coming out with some earnings. Jeremy?
Thank you, Graham. So I had a question for you. I know with all the volatility and stuff going on, what do you see kind of how it looks with what's happened in the past with bear markets and recessions and corrections and all that stuff right now?
Yeah, it's like the three big bears, I guess we need to think about, or little bears, continuing to think about it. Well, we got to think about this. If we've commented on these different numbers, and we got bear markets and corrections. Since 1929, we've had 56 different corrections in the market. Now, a correction is a 10% pullback. A bear market is a 20% pullback. Of that 56, 34 of those were corrections, and they averaged being down about 3.8%, lasted for about 115 days. So just over a quarter. If we look at the bear markets, 22 of those where the markets fell 20% or more. Now, the average drop was about 35%, and they lasted for about 11 months. Now, I know that might not give anyone the feel goods, but we can look at the past to give us some clues on what may happen this time. Now, every time's a little bit different, and I know this administration is a little bit different, and certainly what they're looking to bring to the table with these high and extreme tariffs, without question, is causing concern, anxiety in the market, probably with yourself if you're looking at your portfolio, so on and so forth. Now, if we go one step further, because there's a lot of conversations about recessions. Is this going to cause a recession? Well, it definitely increases the odds. I don't want to sugarcoat it. Like a note we got out to clients or conversations we have, we're not going to sugarcoat it. Things are slowing down. Things aren't as good. But the world's not ending. I mean, we have recessions. We've had 33 recessions since 1854, right? And they lasted on an average since 1854, about 11 months. Now, if we look at the more modern era, let's say from 1950, we've had about 10 recessions. One of those was a depression in 1945. Now, they've lasted roughly around 11 months. Now, recessions aren't all the same. So if you look during that period, we've had recessions last anywhere from 2 months. They've lasted anywhere from 18 months. But the average since 1950, going back to that number, correcting that, that was about 10 months on that. So corrections, bear markets, recessions. Recessions aren't as normal. Corrections are pretty normal. Bear markets aren't as normal, a little more in line to recessions, but they're not uncommon. About every 10 years, we're going to roll into a recession. And a lot of times, by the time you have a confirmation, numbers that we have a negative growth, GDP growth, we might be on our way coming out. And not all of them are down dramatically. Some you kind of drift through, make a bit of volatility, and you come right out. And that could be a bit of what we have if we do go into a recession. It's still not a confirmation yet, but we are expecting slower growth. Obviously, we got more volatility. Earnings are going to come down. Companies aren't going to make big bets until they get more clarity. And if the administration holds true to the aggressive stance that they're taking now, it's just going to lend to more volatility. So all in all, I know, Jeremy, you didn't ask me, but I'd like to give some considerations here. We just think take a little more conservative stance, maybe a little extra cash in the portfolio. If you're taking monthly distributions for retirement, or there's a goal you're trying to pay for in the next 6 to 12 months, maybe you hold a little bit extra in reserves. Don't try to time the market. You're trying to catch lightning in a bottle twice. And we know that is relatively not really possible to do effectively. No one's ever really been able to do it. So, educate yourself, talk to who you work with, talk to us. We're happy to kind of give you a little more flavor of what we think is going to happen. But I think a solid, balanced portfolio, a little bit more defensive, a little more cash, is probably the appropriate way to manage through this, and then look past it. Listen, a year from now, we're going to be worried about something else. The market's always climbing in a wall of worry. 2 years, 3 years, 4 years, so on and so forth. There'll be something else. But right now, we just got to deal with this volatility. And I absolutely know and understand it's unnerving. But you know what? We'll get through this. But let's use a little history as a guide, since we don't know exactly what's going to happen. It's kind of fluid at this particular moment, but we don't want to see anyone go to full cast and try to time getting back in. We know that's a little bit too hard to do. Jeremy?
Gotcha. Well, Graham, we always appreciate the information and expertise. And thank you to our listeners. We do have our next set of retirement planning today classes coming up here 1st of May for Saturdays, May 3rd and 10th, and then Tuesdays, the 6th and 13th. So if you want more information about that, give us a call here at the office or check out our website, and we look forward to seeing you next week.
Take care.